I'm going to tell you why the S&P 500 is actually looking like a broken record, not a fresh hit single. Most market chatter is acting like the index just got a new lease on life, but the chart is whispering something much uglier, a bearish setup that most traders are busy ignoring. Here's my thesis. The combination of gold slipping under the $3,900 support line, a neutral macro regime, and a Fed that's refusing to cut rates until at least 2027 is creating a perfect storm for the S&P 500 to test its lower mid-range. In plain English, the market's safety net is fraying, and the next big move is more likely to be down than up. First, let's talk about the gold breakout because it's the canary in the coal mine. Yesterday gold closed at $387.12, a clean dip under the long-standing $3,900 support on the weekly chart. That line has held since early 2022, surviving the pandemic sell-off and the last Fed tightening cycle. When a metal that's traditionally a hedge against inflation and uncertainty finally cracks, it signals that investors are losing faith in any safe haven narrative. Imagine you're driving through a foggy mountain pass and the headlights suddenly flicker. You're not going to keep speeding, you'll ease off the gas. The same psychology is playing out on the equity side. If the metal that protects wealth can't hold, the equity market loses a key floor. Now bring in the VIX, the fear gauge, which is sitting at 16.86. That's relatively low, but look at the context. The VIX has been hovering between 15 and 18 for the past 6 months, while the equity market has been churning in a narrow band. Low volatility in a range-bound market often masks an underlying tension. Like a rubber band stretched tight, it can snap in either direction. The current low VIX, combined with a gold breach, suggests that the market's complacency is fragile. If a single negative shock hits, we could see volatility surge faster than a popcorn kernel in a hot pan. Next, consider the bond market. The 10-year Treasury yield is at 4.45%, edging up from a month ago. Higher yields make stocks less attractive because they raise the cost of capital and increase the discount rate applied to future earnings. In a simple dividend discount model, a 0.5% rise in yields can shave off roughly 5% of a stock's present value. That's a tangible erosion of equity valuations, especially for growth-heavy constituents of the S&P 500. Picture a house that's suddenly taxed higher, the owner is less inclined to pay a premium price. The same pressure is now hitting the index. And don't forget the Fed's stance. The target range of 3.50–3.75% is being held steady, with the tone firmly hawkish. No rate cut is on the table until possibly 2027, and the year-end projection for the 10-year is about 4.1%, a modest dip that won't change the equity risk premium dramatically. In other words, the monetary environment is locked in a high-interest, low-growth mode. When you stack that against the gold breakdown and a low-volatility, high-yield backdrop, the odds tilt toward a bearish bias for the S&P 500. Let's stitch these strands together with a concrete example. Suppose you're watching SPY, the ETF that tracks the S&P 500, sitting at $746.74. If the index respects the $730–$720 support zone, we could be looking at a 3%–4% pullback from today's level. That isn't a massive crash, but it's enough to wipe out the upside that many analysts are still touting. A disciplined trader could set a short position around $740, place a stop just above $750 to protect against a sudden rally, and aim for a take profit near $710. Those numbers align with the recent swing highs and lows, and they respect the risk-reward ratio that a professional desk would demand. Now, let's hear the other side of the coin. The bullish camp points to the surge in U.S. equity fund inflows, a record weekly inflow into tech stocks, driven by optimism around the delayed U.S.-Iran peace talks. They argue that the elevator up and the stairs down narrative for mortgage rates means the housing market could stay resilient, feeding consumer confidence and supporting earnings growth. They also note that the DXY, the dollar index, is holding at 100.81, which some interpret as a sign that the U.S. currency isn't weakening, thus preserving the attractiveness of dollar-denominated assets. Those arguments have merit, especially if the peace talks finally materialize and oil settles near $75.85. easing inflation pressure. However, the bullish narrative leans heavily on a single catalyst, the peace deal, that remains uncertain, and it underestimates the structural drag from persistent high rates. Even if oil stabilizes, the higher Treasury yields will continue to punish growth valuations. Moreover, the inflow numbers, while impressive, often lag real-time sentiment. Money can flow in and out just as fast once a surprise shift occurs. When you weigh the evidence, the bearish setup feels more compelling. Gold's break below $3,900, the tightening yield curve, and the Fed's steadfast hawkishness create a confluence that historically precedes equity pullbacks. The bullish case rests on a maybe-later scenario that hasn't materialized yet. So, if you have to pick a side, the weight of data leans toward caution. What does this mean for your money? First, think about positioning your portfolio to survive a modest dip. If you hold SPY, consider a protective collar. Buy a put option around the $730 strike and sell a call at $770 to fund part of the put premium. That caps upside but gives you a floor if the index slides. Second, look at sectors that tend to outshine in a higher rate environment, financials and energy. A long position in a bank ETF like XLF could benefit from a 4.45% 10-year yield, while a modest exposure to oil-related equities can capture any upside from steady $75.85 prices. Third, keep an eye on gold through a short-term ETF like GLD. A break below $3,900 suggests a possible move down to the $3,800 to $3,750 range, which you could target with a put spread. Remember, these are illustrative structures. You'd adjust size and stops to fit your risk tolerance. In closing, the S&P 500 isn't about to sprint to a 30% gain this year. The chart, the gold break, and the macro backdrop are all pointing to a more measured, perhaps downward trajectory. If you're watching the desk's live moves, you'll see us tightening stops, scaling into defensive positions, and staying ready for that next volatility pop. Join the conversation on our Discord where we break down each trade in real time. And as always, educational only, not financial advice.